Welcome to This Explainer. Okay, so let's tackle a situation I think almost all of us know way too well. You do the responsible thing. You diligently put money away every single month, and honestly, you feel pretty great about building up a safety net. But then you check your banking app, and the needle has barely moved. Despite doing literally everything right, you just feel completely stuck.
Okay, let's dive right into this, because here is the extremely frustrating mathematical reality. Let's say you stash $10,000 in a typical savings account. A full year goes by, and at a standard 0.5% interest rate, you've earned a mere $50. Just $50. Meanwhile, everyone around you is talking about index funds and compound growth, and it leaves you wondering, wait a second, am I doing this completely wrong?
Now, don't get me wrong, saving is absolutely essential. We have to do it, but we really need to shatter the illusion that it's going to build real wealth. Saving and investing are two very distinct tools with entirely different jobs. Your savings account exists to protect your money. Your investments, on the other hand, exist to grow your money. Basically, saving is your starting line, but it absolutely cannot be your finish line.
So you might be wondering, what's the actual alternative here? Well, historically speaking, the S&P 500 has returned an average of about 10% per year over long periods. If your $10,000 earned 10% instead of that measly 0.5%, you'd make $1,000 in just 1 year. And while an extra $1,000 might not sound instantly life-changing today, just wait until we stretch out the timeline.
And this brilliantly illustrates the massive wealth gap caused by the magic of compounding over time. Look at what happens over a 20-year period. If you leave your $10,000 in a 1% savings account, 2 decades later you have $12,200. But if you invest it at a 10% historical average, you're sitting on roughly $67,000. Seriously, the biggest wealth gap out there isn't between savers and spenders. It's between savers and investors.
Right about now, you're probably thinking, okay, but what if I lose all my savings? And you know what? That is a totally valid fear. The barrier holding most people back isn't actually the math, it's the psychology. Saving feels really safe because the number doesn't move. Investing, though, it comes with emotional volatility, and that up and down movement is deeply, deeply uncomfortable. Honestly, that exact psychological hurdle is why the transition from saving to investing shouldn't happen all at once. It really needs to happen in stages. So let's walk through a core 5-step framework that will take you from a saver to an investor safely and systematically without risking your financial security.
Step 1. This is absolutely non-negotiable. Before you invest a single dollar, you need to build a real emergency fund. We're talking 3 to 6 months of living expenses, sitting safely in cash. This money isn't for jumping on a hot new stock. It's strictly there for life's unexpected problems. Think of an emergency fund as an impenetrable fortress around your investments. It completely prevents you from panic selling when your car breaks down and you need cash fast.
Once that fortress is totally built, step 2 is separating your money mentally. Just imagine you have 2 buckets. Bucket 1 is your safety money. That's your emergency fund, and it never, ever fluctuates. Bucket 2 is your growth money. Because your safety money is completely secure in that first bucket, it dramatically reduces your anxiety, and you mentally give your growth money permission to fluctuate over a long timeline.
All right, step 3. Start small. Let's completely debunk the myth that you need thousands of spare dollars to begin investing. Today, you can start with literally just $50 or $100. In this transition phase, your initial goal isn't massive profits, not at all. It's simply building the habit of putting money into the market. Getting the habit down matters far more than perfectly timing your entry.
Step 4 is all about keeping it simple. A lot of beginners make the mistake of jumping straight into complicated strategies like day trading or crypto. But the simplest investments usually win out over time. Broad market index funds are a fantastic tool here. They provide instant diversification and target really reliable long-term growth. It completely eliminates the stress of having to guess which single company is going to be the next big winner.
And hey, you really don't have to just take my word for it. Warren Buffett repeatedly states that low-cost index funds are the absolute best choice for the vast majority of investors. Seriously, when one of history's greatest stock pickers tells you to just buy the whole market and keep things simple, you listen.
Which brings us to step 5. And honestly, this one is wonderfully boring. Consistent investing. Real discipline is what separates successful investors from gamblers. It's all about putting just a little bit of money into your growth bucket every single month and completely ignoring the sensational news headlines and all that market noise. Now, what's really interesting about this math is seeing exactly why this boring consistency pays off. Let's say you invest just $300 a month at an 8% average return. After 25 years, you have roughly $285,000. But look a little closer at the breakdown. You only contributed $90,000 out of your own pocket. The remaining $195,000, that is pure investment growth. That is compounding doing all the heavy lifting for you.
You can kind of think of it like this. Saving is basically like storing seeds in a glass jar. They look super neat and they are completely safe, but they're never going to grow. Investing is taking those exact same seeds and actually planting them out in the soil. At first, it looks messy, and you definitely don't see immediate results. But with a little patience, things start to grow, and it eventually yields a harvest that is way, way bigger than those original seeds.
Okay, but we really have to address the elephant in the room here, right? What if a storm comes? What if the entire market just crashes? It's the single most common objection. But here is the truth. Market crashes are completely normal. They've happened dozens of times in the past, and for sure, they will happen again in the future.
Well, here is exactly how you flip that narrative of fear completely on its head. Experienced investors actually do not panic during market drops. They kind of celebrate them. Why? Because when the market drops, your consistent $300 suddenly buys way more shares at much lower prices. The stock market is essentially running a clearance sale. Accumulating more shares during a downturn sets you up for drastic returns when the market eventually recovers. You see, you're thinking in decades now, not days. So, the real core takeaway from this whole explainer is finding the harmony between these two concepts. Saving gives you stability. It's a solid bedrock protecting you from life storms. Investing gives you freedom. It's putting your money to work for you so that eventually you don't have to. The earlier you can combine your safety bucket and your growth bucket, the more incredibly powerful your financial future becomes. Which leaves us with one final and pretty vital question to think about today. Take a really honest look at your own finances. Are you currently stuck just protecting your seeds in a glass jar, or have you actually started planting them for the future? Wherever you happen to be right now, you've got the exact blueprint to move forward. Thank you so much for joining me for this explainer. Now go put your money to work.